Hey there, and welcome to This Explainer. Today, we are going to completely demystify the stock market and give you a really simple step-by-step roadmap to start investing smartly. Look, if you've ever felt totally overwhelmed by financial jargon, or maybe you thought you needed to be a literal millionaire just to start growing your wealth, well, you are absolutely in the right place. We're going to break down exactly how your money can finally start working for you. Okay, over the next few minutes, we're going to follow a really simple 6-step roadmap. We'll quickly cover why start investing now, understanding risk and assets, the power of diversification, smart investing strategies, avoiding common beginner mistakes, and finally, your simple first steps. All right, let's dive into section 1. Why start investing now? Basically, we need to talk about the cost of inaction. So you might be wondering, what is the cost of doing nothing? A lot of people think completely avoiding the stock market is actually the safest bet you can make. I mean, after all, if you don't invest, you can't lose your money, right? Well, let's take a look at a silent thief that is constantly stealing your money's value right out from under your mattress. That silent thief? It's inflation. Simply put, inflation is an overall, general increase in the price of everyday goods and services. What this means in plain English is that your money literally buys less over time. Think about it like this. If you need $50,000 a year to live comfortably right now, in 30 years, assuming just a totally normal 3% inflation rate, you're going to need roughly $121,000 just to maintain that exact same lifestyle. So if your money isn't growing to keep up with inflation, you are actually losing wealth by doing absolutely nothing. But don't worry, there is a solution to this. Let's say you buy a $2 slice of plain pizza every single day. Over a year, that adds up to $730. If you decided to skip that daily pizza, save the cash, and invest it where it earns just a modest 5% interest, after 30 years, that simple, tiny habit turns into over $3,155. Seriously, that is the unbelievable power of letting your money earn money for you. And that brings us to an absolutely fundamental concept: compound interest. This is the magic of earning interest on your interest. It's kind of like a snowball rolling down a hill. It just gets bigger and faster as it goes. A really great practical shortcut to understand this is something called the Rule of 72. If you take the number 72 and divide it by your expected return rate, let's say an average 9% return from the market, your money will actually double every 8 years, just by sitting there. Okay, moving right along to section 2, understanding risk and assets and finding the right balance for you. When it comes to investing, you have to understand that risk and reward are inextricably entwined. They're a package deal. Holding cash or cash equivalents, things like certificates of deposit or CDs, well, that's very low risk. You probably won't lose a dime of that money. But the reward is so incredibly low that you remain super vulnerable to that silent thief inflation. On the flip side, things like stocks and real estate are higher risk. They can be volatile in the short term, bouncing up and down, but they offer the absolute greatest potential for long-term growth. Basically, you have to take on some measured risk to get a meaningful reward. To put it as simply as possible, there are 2 main categories of assets you really need to know about: stocks and bonds. Buying stocks means you're buying a tiny, actual piece of ownership in a business. You're buying in for growth, but yes, it comes with higher risk. Buying bonds, however, just means you are loaning your money to a company or a government. In return for that loan, they promise to pay you a steady, reliable interest rate over time. So it's lower risk, but inherently offers a lower reward. Which brings us to section 3, the power of diversification. This is all about how we mix those assets safely to protect your hard-earned cash. Imagine a street vendor for a second. If they only sell sunglasses, they make absolutely zero money when it rains. If they only sell umbrellas, they make nothing on a bright sunny day. But if they sell both, they guarantee sales in literally any weather. Investing works the exact same way. By buying different types of assets, you essentially protect yourself from losing everything if one specific market happens to struggle. So a diversified portfolio beautifully spreads out your risk. By holding a mix, say 60% in stocks for that long-term growth, 30% in bonds for stability, and maybe 10% in cash equivalents for emergencies, you greatly reduce those wild, stressful fluctuations. It really smooths out your overall investment returns. You know the old saying, right? You just aren't putting all your eggs in one basket. Now, the absolute easiest way for beginners to achieve this kind of instant diversification is through index funds and ETFs, which stands for exchange-traded funds. Instead of trying to guess and pick one single winning company, these funds let you buy a tiny slice of hundreds or even thousands of companies all at once. For example, an S&P 500 fund gives you a piece of the 500 largest U.S. companies in one go. Index funds and ETFs are super similar, but ETFs trade instantly throughout the day, exactly like regular stocks, while index funds trade once at the very end of the day. And the best part? Because they practically run on autopilot, their fees are incredibly low. All right, let's keep the momentum going with Section 4, Smart Investing Strategies. It's time to talk about the actual accounts and timing you'll use. So to actually buy these investments, you need a specific type of account. A standard brokerage account is fantastic for flexibility. You can put money in and pull it out whenever you want, but you are going to pay taxes on any gains you make. Alternatively, retirement accounts like an IRA or a workplace 401k offer unbelievable tax advantages. Depending on the specific type, your money can actually grow completely tax-free over the course of decades. The only real trade-off is that you generally can't withdraw those funds without taking a penalty until you reach retirement age. Okay, once your account is officially open, how do you actually buy? Well, the secret is a super simple strategy called dollar cost averaging. Instead of trying to perfectly time the market, which, let's be honest, even the seasoned pros fail at constantly, you just invest a set amount of money on a regular, predictable schedule, like say $50 every single month. When the market is up, your $50 buys a few less shares. When the market is down, boom, it buys more shares on sale. Over time, this automatically averages out your purchase price and completely takes all the stress and emotion out of investing. Section 5. Avoiding common beginner mistakes. Before you go and hit that buy button, we definitely need to cover a few pitfalls that trip up almost every new investor. Without a doubt, the biggest mistake is panic selling. Look, markets naturally dip. It's what they do. But if you sell out of fear during a drop, you literally lock in your losses and completely miss the eventual recovery. Second, avoid chasing random trends or, hot stock tips from a buddy without doing your own research. Third, really know your own risk tolerance. Don't buy a wildly aggressive portfolio if seeing market drops is going to keep you awake at night. And finally, never ever ignore fees. High expense ratios, those are the annual fees that mutual funds charge to manage your money, will quietly eat into your compounding profits year after year like termites. Always keep your costs low. And finally, Section 6, your simple first steps. Let's talk about how you can confidently take action today. Getting started is literally as simple as 1, 2, 3. Step 1, open an investment account, whether that's a standard brokerage or an IRA. Step 2, pick a broad, low-cost index fund or ETF, like one that tracks the total stock market or the S&P 500. And Step 3, automate it. Seriously, set up an automatic transfer from your bank account every single month. Treat it like a mandatory monthly bill for your future self, so you never forget, and honestly, you never even have to think about it. Let's do a really quick recap checklist to remember all this. Respect the hidden cost of inflation. Harness the sheer magic of compound interest. Always diversify so you don't lose it all on one bad bet. Keep your fund fees as low as possible. Don't panic when the market takes a natural dip. And finally, automate your habits to ensure you stay consistent. Remember, starting with just $50 a month right now is meaningfully better than waiting 5 years to save up a lump sum of $5,000. Why? Because compound interest absolutely needs time to work its magic. So I want to leave you with a thought to chew on. Time in the market matters so much more than the amount you start with. So what is really stopping you from investing in your financial future today?